Today, we're going to be covering the Secure Act and what it means for your tax filing here coming up. There's not a whole lot of changes per se to what you need to know for filing, but there are some certain things with regards to tax planning that are going to be coming up that are going to be especially pertinent to you. Let me just done correctly. My name is Alex Perny. I've been with Advanta IRA since 2012, so I've been doing this for quite a while. I the one here tasked primarily for doing the research on the Secure Act and what it can potentially mean to our clients. I do see someone raise their hand. If you do have a question, make sure you type that in, as audio has been muted. So if you do have any questions pertaining to this, or maybe something that's outside the scope of what I'm talking about, feel free to ask. I've read through the long form of the bill and kind of extracted what is going to be most pertinent to our clients as well. So please feel free to ask any questions that you might have to that regard. Okay, let's see if this works. Before we get into the actual content of what we're presenting today, we do need to disclaim that Advanta IRA and our employees, we do not provide tax, legal, or investment advice, nor do we promote or endorse any investment products. Especially important today when talking about tax planning strategies and what it means to file your taxes. We really want to stress that this is for educational purposes only, and if you are going to make a decision that directly impacts your filing or a decision made with your tax planning, please do consult a professional that can give you, excuse me, proper advice before entering into any type of financial agreement or arrangement that will affect your taxes. So getting right into this, the main thing that most people are going to be affected by is the change to the ability of individuals to make contributions to IRAs. Now, previous years, if you were over the age of 70 and 1/2, you no longer were able to make a contribution to a traditional IRA. You also had to start taking required minimum distributions. Now, this has been repealed with the Secure Act, which is very good news for individuals that are continuing to work later in life, and especially pertinent to those individuals that are invested into illiquid assets, things like real estate or maybe a long-term mortgage note, or something that would require a required minimum distribution that would exceed the amount of cash held within the account, thereby creating an issue where you might be having to do an in-kind distribution of an asset in order to satisfy that. Okay, we have a question. Thank you very much, John, for asking. So John asks, can you use money from outside of your IRA to pay the RMD that is due? So to an extent, yes. Now it's going to be determined on a few different factors. Now, especially pertinent to these points right here of being able to make contributions later on in life, such as individuals with traditional IRAs past the age of 70 and 1/2, if you have a required minimum distribution that is X dollars, let's say, for example, to John's question, you have a IRA that is valued at $100,000, but it is completely invested in assets, whether those be liquid or illiquid, something you do not or cannot liquidate, do not want to or cannot liquidate immediately in order to satisfy the distribution. Well, what do? If you have earned income that at least exceeds the $6,000 or $7,000 maximal contribution limits, or for individuals of the age of 72, it is going to be the $7,000 contribution limit. You can make a contribution to the IRA and then have that distributed in order to satisfy the required minimum distribution. Now, the nice thing about this is that when you go to make the contribution, it does not affect your calculation for what the required minimum distribution of the previous year is. When you do a calculation for a required minimum distribution, you use the snapshot value as of 12/31 of the previous year in order to calculate that distribution. So by virtue of the fact of making that contribution in the following year, it will not affect that calculation. So to answer your question, John, yes, you can use outside monies to pay it, but you do have to make sure that they are monies that are earned income and that are then in turn contributed to the IRA in order to then be distributed. It may seem like a lot of work to kind of just have something sent right back out to you, but that would be the proper order of operations in order to have that done. Now, especially important to those individuals with traditional IRAs, unlike individuals with Roth IRAs, you had what's called a required minimum distribution, which I just briefly touched on, which is once you reach a certain age, you are required to start taking funds out of an IRA, a traditional type IRA. And this also has to do with 401ks and SEP IRAs as well, and I'll get into that in a moment. But if you're of the age of 70 and a half previously, you had to start taking money out of a traditional IRA. That age has now been pushed back to 72. So if you were going to be turning 70 and one half this year, you do not have to take a required minimum distribution. So if you were looking to have to take a distribution before your tax filing deadline this year, you no longer have to do that if you're not of the age of 72. Now, if you're 72 this year, or 73 or older, you would have to look into that as making sure that you satisfied your RMD in order to file your taxes correctly. But if you were going to be turning 70 and one half this year, you don't need to worry about taking a required minimum distribution as you would in previous years. You have until the age of 72 now to make that contribution. And you also have the elimination of having, excuse me, of having to have the cap on when you can contribute. Now you can contribute in perpetuity so long as that you have earned income in order to make that contribution. Now, there's a few different definitions of what earned income is, and one of them actually changed a little bit. Now, it doesn't have so much to do with individuals who are over the age of 70 and a half, although, or sorry, 72 and a half, sorry, that are over the age of 72, but taxable income paid to you as a graduate in a graduate program, such as fellowship or stipends, can now count towards your ability to make a contribution to an IRA. So again, albeit not necessarily geared towards the older individuals that are looking to just be able to make a contribution, even if they are still working, younger individuals who are in graduate and postgraduate work can utilize monies that are paid to them as those types of income in order to make contributions to an IRA. Typically, those individuals are going to be showing very little to no earned income from a job, such as working a 9 to 5 or something, if they are in studies to further their career. So that's a nice change that also has been brought forth by this legislation. Now, one thing to remember, I said I would also circle back into 401ks and retirement plans, is that with regard to employer-sponsored plans, there is some ambiguity as to your ability to defer your required minimum distribution until you are 72. Now, with those types of plans, if there are collective bargaining agreements or there are plan adoption exemptions, meaning that when the plan is adopted, the plan sponsor specifies an age that is earlier than that for required minimum distributions, you have to default back to those agreements in order to see when you would have to take a distribution from that account. So collective bargaining and plan adoption agreements can supersede some of these, but again, if you have rolled money out of a retirement plan, such as a 401k, 403b, SEP IRA, things like that, if you have rolled funds out into a traditional Roth IRA, these numbers that I've just presented to you will hold true for that. So the elimination of the 70 and one half cap for contributions and the increase of the required minimum distribution date until the taxpayer has reached the age of 72. And I apologize for having to skip slides like this. My slides are not advancing in PowerPoint. Now, here's a big one. A lot of people are upset, and there is definitely some reason to be upset with regards to this elimination, especially with regards to tax planning. And it kind of ties into individuals that are a bit older as well with regards to how they plan their estates. So a lot of people like to call this the elimination of the stretch IRA. Now, the stretch IRA isn't a technical term so much as if you read IRS code, you'll see something referring to a stretch IRA. What it is the kind of the general term of what people use to say, hey, if I pass on a IRA to someone other than my spouse, they can then stretch those payments over the course of their lifetime by utilizing their single life expectancy table instead of my life expectancy table, which is great from the aspect of being able to create a lot of tax-free or tax-deferred income for your heirs and not have the government be taking large chunks of money out of that. So it was a very big tax planning strategy for a lot of people, especially those with larger IRAs. So the old rules were that any non-spousal beneficiary had the ability to stretch their required minimum distribution or their RMD payments over their whole life expectancy. The IRA beneficiary had several choices when it came to inheriting an IRA. They could take the IRA and stretch the payments over their single life expectancy. They could disclaim the amount saying, hey, I don't want any part of this IRA. They could take the entire payment over a 5-year distribution cycle, similar to what like a 72T payment is, or sorry, those were their options. And then beneficiary Roth recipients even had a better deal in that they could do with their single life expectancy, take tax-free payments over their entire life cycle. So it was a very good deal for people that were inheriting IRAs. Now, the new rules, and keep in mind that these are primarily geared towards non-spousal beneficiaries, so meaning anyone other than your spouse that inherits one of these accounts is going to have these new rules applied. So under the new rules, if you are a non-spousal beneficiary, so a child, a friend, a charity, whomever is receiving it besides a legally married spouse, must distribute the entire account by the 10th year following the primary account holder's death. So 10 years from the year in which the individual dies, the entire account has to be distributed. Now, this has to do for Roth or traditional accounts, so it doesn't necessarily matter which type of account it is. It has to be distributed over that 10-year period. Linda asked a great question. Are existing inherited IRAs grandfathered under the new rules? And yes. So this only has implications for individuals that died as of January 1. So if someone had let's call it a stretch IRA beneficiary designation elected and they died December 31, 2019, they would still have the old rules applied in a quote grandfathered in scenario. But anything new, even if they had made these elections to have these beneficiaries and this estate planning done previously, if the individual dies as of January 1 of this year and forward, they are applying the new Secure Act stretch IRA rules of the 10-year distribution plan, if you will. So non-spousal beneficiaries got another question. So Scott asked, do you have to take distributions within the 10-year span? Now, I'm hesitant to give a definitive answer on this. The legislation, as I have read it, would indicate that the account has to be distributed by a certain date, not indicating necessarily that you have to take distributions every single year. I have seen, read, and researched, but this stuff is so new that it's hard for me to give a definitive answer of just having to have it distributed on that 10th year. It would seem the way it's written is that they have the ability to just distribute it all in that 10th year. You don't necessarily have to take incremental distributions. But keep in mind, although that may sound attractive by being able to compound tax exempt or tax-free earnings into that account, especially, and this has way more to do with traditional than Roth IRAs, because if it's a qualified Roth distribution, they're not paying taxes. If it's a traditional type IRA that the non-spousal individual received, then they could potentially have a very large tax bill. So what it's going to create is something where people are probably going to be distributing chunks across a 10-year period in order to keep them out of much higher tax brackets. Because if you're going to be paying 39% in taxes, if you take a very large lump sum 1 year on a portion of that distribution, it definitely might make a little bit more sense for someone to take smaller chunks of that pool of money over that 10-year period in order to make sure that they are reducing the amount of taxes that they would have to pay. But again, this stuff is also new that we haven't seen the exact implementation of it, and some of the minutia of exactly how exactly you enforce this is a little bit gray. So we're hoping for some clarification from the IRS on this and some of the other governing bodies. But as it is written now, it doesn't actually specify, if there's a specific date within those 10 years. It just says has to be distributed by the 10th year following the decedent's death. So the nice thing about this is that spouses are still allowed to treat an inherited IRA as their own and not deplete it over 10 years. So presently, before the Secure Act and currently under the new Secure Act, if your legally married spouse named you as the primary beneficiary of the account, you didn't have to take it as a beneficiary IRA. You didn't have to do anything. It just became your IRA. And unless you were of the age of needing to take required minimum distributions, you didn't have to take any, such as in the case with Roths, or if you were under the age of 70 and 1/2. Now with the increase to 72, that is bumped up a little bit. But if you inherit a Roth IRA from your spouse, you don't have to do anything special with it. However, if you do have a beneficiary IRA that you inherit from your spouse and you treat it as your own, so it's just stays the same and it's a traditional type account, you will have required minimum distributions once you reach the age of 72. So keep that in mind, but there is no special different calculations for those required minimum distributions. It's just that now you have until the age of 72 in order to make those distributions. Now, one exception for the elimination of the stretch IRA is that if the individual is under the age of majority. Now, again, there is some ambiguity in this because states typically define the age of majority differently, whether that is 18 or 21. So if a non-spousal beneficiary inherits an IRA, and let's say they are 5, they do not have to start counting that clock of having to deplete that IRA until they reach the age of majority, which is nice. So that way, when let's say they're 15, they're not having to take a humongous tax burden. This means that in their late 20s or maybe by the age of their early 30s, they will have to have that account depleted, but they still do have time to invest and compound those tax-free earnings in that account for some time. Okay, Scott asked, does the inherited 401k, Roth 401k continue to earn tax-free after inheriting? Well, there's a few parts to that question, Scott, and let's unpack that a little bit. So with a 401k, it can either be Roth or traditional, meaning that you either make tax-deductible contributions or after-tax contributions. Now, if an individual inherits a decedent's retirement plan, they have to roll it out into a Roth or traditional IRA, depending on what the applicable basis into either of those two pools is. Now, yes, everything in that account, while it's still existing, continues to grow tax-free. You don't have to necessarily distribute earnings or anything. So once you've inherited in an account, nothing fundamentally changes about the earnings or anything that's going back into that type of an account. What does change is having to then in turn have the account completely depleted by a certain date if you are a non-spousal beneficiary. So to the main point I think you're asking of your question, yes, everything continues to earn tax-free. You're not paying any taxes on anything that is compounding within that account. However, depending on the status of the nature of your beneficiary status to the decedent and the type of account is going to determine what type of taxable event you may or may not have coming in the near or a little bit farther down the road future. So just to make sure that people do understand this, if you do have someone that has passed away in this year and you're concerned about when your 10-year clock starts, if the beneficiary is a non-spouse and they are a minor for a general term, the technical term would be age of majority. So this doesn't necessarily mean if they're 18 or below. They don't have to start that 10-year clock of having to have that account distributed until they reach that age of majority. And again, anything that has happened or any beneficiaries that have been named or people that have died prior to January 1 of this year have the old rules applied to them, not these new rules that we're discussing here today. Okay, so to kind of reiterate, if the non-spouse beneficiary is not the age of majority, that is one of the exceptions. The new account does not define the age of majority, or the new act does not define the age of majority. That is typically defined by state. So, for instance, Alabama has different views on what the age of majority is than Florida, then does Michigan, Ohio. They all kind of define it differently. So we're going to have to wait a little bit and to see how this kind of actually fleshes out. And unfortunately, we don't have a definitive ruling on this. We kind of have to wait for the IRS to either get sued about it and then have them issue some type of clarification, or they will issue a clarification on their own if they have enough inquiries as to what the age of majority means for that. Now, there are some additional exceptions, is that if the non-spousal beneficiary is fully disabled, and the nice thing is that full disability is defined not only by physical incapacity, but also mental capacity as well. So if you have an individual who receives a beneficiary IRA who has some type of mental incapacity, whatever that may be. It doesn't necessarily have to be a physical incapacity. They don't have to take those distributions over that by that 10th year. They can still stretch it out for them in order to, care, cost of care, things like that. That is something that I was very happy to see specifically included, that it actually carved out for mental capacity and mental handicaps, as well as just physical ones as well. Or if the non-spousal beneficiary is chronically ill, the chronically ill, I believe, and doesn't specifically state it, but I believe you have to refer back to the Department of Social Security's definition of long-term chronic illness as to whether or not that would be an exemption. It doesn't specifically state that in the actual legislation, but from what I've gathered, that's typically where, with regards to IRS exemptions, they pull for exemptions to other rules for chronic illness and taxation. So those are two big things to keep in mind, is that if you have full disability or you are chronically ill and you're a non-spousal beneficiary, the stretch IRA elimination does not apply to you. Now, there's one other exemption. It doesn't necessarily fall to self-direction as much, but it's important to understand. If the account holder invests into a qualified annuity, and that's just the term that they use in the legislation, basically it just means that if you purchase an annuity contract from a licensed insurance provider in your state, and for those of you who don't know, an annuity contract is basically buying a guaranteed revenue stream. You give a insurance company X number of dollars, let's say $100,000, and then they guarantee you a, let's say, 3% return over the next 30 years until all of the returns and the principal has been repaid. Kind of like a loan. It's definitely a little bit more nuanced than that, but that's what an annuity contract is. So if the individual account holder before the date of death has invested into an annuity contract that does not exceed the beneficiary's single life expectancy, they do not have to distribute that asset, and the stretch elimination does not apply to them. They can continue to stretch that out over their life expectancy so long as that annuity contract does not exceed their single life expectancy. So that's something that I think is going to be a big workaround for people, especially if individuals know they have impending circumstances that will result in their death. They're getting to an advanced age and they want to prevent their inheritors from having to take large distributions or being able to stretch some of those payments out, is to invest into an annuity contract before their date of death. Now, keep in mind, even though that the IRA still exists after an individual dies and it has to be parsed out per their beneficiary designation and assets can still be maintained, the annuity contract has to be dated and has to be funded before the account holder dies. So that is a very important aspect to keep in mind with regard to that exemption from the elimination of the stretch. Now, not extremely pertinent to this year's filing deadline, but it is in future years, is something very important to keep in mind, is that previously you had to adopt a employer plan, a 401k, if you're doing a solo 401k, by the year's end of the year in which you'd like to make contributions. Even though you could make previous year contributions, you had to at least adopt the plan in that given year. And there was no ability to adopt a plan before the filing date, before your filing date for the previous year. Now, you are able to adopt a plan in the following year. So especially for people looking forward to 2021, you are able to adopt a plan in the following year before your tax filing deadline and make contributions of the previous year. You don't have to adopt that plan in the calendar year anymore, which is very good for people because, especially with businesses, you may not know what kind of earnings or your ability to contribute to a plan are, and adopting a plan might be presumptive given that you don't know exactly how much money you're earning or how much you could contribute to it. Yes, Michelle, the slides will be available to attendees after this. So that is a very good thing, not necessarily, again, pertinent to the tax filing coming up next month, but especially if you are a self-employed individual or someone looking to adopt a solo 401k, you definitely have a big amount of leeway to do it now, as opposed to previously when you had to at least adopt a plan by year's end. Now, this is going to be by your filing date plus any extensions. So keep in mind that the 401ks are done against the corporate filing deadline. So your extension is going to be the corporate extension into October, as opposed to a personal filer, as most people would think, especially with a solo 401k. But if you do file your taxes timely, keep in mind that that plan would need to be adopted by that date in order to be applicable for that. I'm not going to spend a ton of time on this, but one other big thing that came about with the Secure Act is that previously you were able to exclude people from 401ks a little bit easier. Now, while that may sound bad, part-time individuals or transient workers for companies, previously you did not have to calculate them as a full-time employee in order to do the compliance for your 401k. Now, with 401ks, if you have any employee who works 500 hours per year, or sorry, 500 hours in a rolling 12-month period for 3 consecutive rolling 12-month periods, they have to be considered a full-time employee for the purposes of plan discrimination testing. So if you have someone that works 500 hours, let's say helping you file your taxes every year, and then works only maybe 2 or 3 months a year, and then none the rest of the year over 3 consecutive 12-month periods, they have to be included in your 401k plan. There is some exceptions for collective bargaining and other types of plan document exemptions, but this is a big one, especially for people who, let's say, maybe run a surfboard rental at a beach or something that is very seasonal, or again, have a lot of transient workers. It can definitely increase the cost to you as the plan provider for those types of plans. Now, this is going to be the slide that I believe I'm ending on, and it is a big one, especially for filing your taxes this year. If you are getting ready to adopt a child, or you have just had a baby, if anyone listening is, congratulations. But one big thing that came out of the Secure Act is that we now have the ability to take a $5,000 distribution within 1 year of the date of birth or adoption of the child, tax-free, and you have the ability to roll those funds back in without a time limit. So if you just had a child and it is within 1 year, so even back into April of last year, you can take a $5,000 distribution to help with those childcare costs, or birth costs, or children are expensive. And if you are adopted a child recently within that same time period, you can do that as well. Now, you have to wait until the child is actually born or finalized, the adoption is finalized, in order to take that distribution. Now, again, if you are if this happens after your tax filing deadline, not a big deal. It's not taxable, still reportable. But if you are looking for some funds to use, you can access your IRA like you were able to previously for like first-time homebuyer credits and things like that. You are able to access a portion of that should I say, to help offset the costs of having or adopting a child. Now, if you are remarrying, you cannot use this distribution stipulation for the adoption of a spouse's child. It has to be a child you have together, or you are newly adopting outside of your family. So it cannot be a spouse's existing child. And you don't have to roll the payments back in one payment. You can spread it out over multiple years, and there is no restriction on how long you have to roll those back in, which is fantastic, especially with the expensive nature of having children. You don't have to worry about saying, oh, if I take this distribution, I'm then in turn going to have to roll it back in within a year, and I have to make sure my finances are in order for that. You get the ability to take your time to roll that back in, and you don't have to, and the only thing you need to be cognizant of with regard to that is that you cannot roll more than your distribution back in. Now, you can have multiple distributions out for multiple children, and just keep in mind that you can't, roll back in more than, let's say, if you have 3 children over the course of a couple of years, you can't roll back in more than 15,000. You can't roll back in earnings or anything like that, but you can have multiple distributions out. Now, one thing I don't know, and I haven't been able to find a definitive answer on this, is that let's say you have twins or you adopt multiple children. I don't know if you can do it at once for a simultaneous birth. It just says, it leaves a little bit of ambiguity in how the legislation was written with regard to that. So unfortunately, I don't know that, although I think it would be something very good for them to answer for people that are looking to have children or adopt a child. And with that said, there's not a whole lot to go into filing your taxes. I wanted to kind of truncate this a little bit. I know everyone is probably busy thinking about all of the tax planning things that they need to do. The stretch IRA elimination is the big one, but at least for filing your taxes, what you really need to look at is the ability to take that $5,000 distribution for any type of childcare expenses if you just had a child, or if you are looking to or if you have just received a IRA from a decedent between now and your tax filing deadline, the fact that you have to start that clock on those distributions, and then you definitely need to contact your tax advisor or a CPA or an accountant to see whether or not that you are in a good position to take one of those distributions in this taxable year by your filing deadline, which is actually on the 15th this year. There is no applicable extensions for a holiday or anything like that. So that's pretty much what I have for you today. I'll stick around for a few minutes until everyone has signed off to answer any questions. Looks like we got one coming in now. Let's see, Wayne asks, can we wait until the tax deadline to decide how much to contribute for the previous year? Yes. Now, if you're specific to contributions, you have to make the contribution by your timely filing deadline. Even if you file for an extension, the only time you get to make a previous year contribution with an extension is for like a 401k or a SEP account. For traditional and Roth IRAs, you literally have up until the day you file your taxes, so April 15th, which is a Wednesday, I believe, next month, to open the account and make a previous year contribution. You have up until that date. If you wait till the day after, fortunately, you've waited too long. But yes, you can make the previous year contribution up until that filing date for traditional and Roth IRAs. Well, it looks like we still got about 35 people on here, so still stick around to answer questions. Like we got another question coming in here. So yes, so contribution deadlines for the 401k have not changed. So just the creation deadline. So previously you had to adopt the plan by December 31st in order to make a previous year contribution, specific only to 401ks. My pleasure. Thanks, Wayne. I see that someone has raised their hand. You do need to type into the chat box. I don't have any ability to do audio. Javier, I see your raised hand. If you can type in your question, I'm happy to answer. Nathan, yes. Sorry you were stuck in another meeting, but yes, the recording and the slides will all be up on, excuse me, on our YouTube channel. We'll email out a link so you'll be able to circle back. And if you have any specific questions, feel free to contact me directly. I am more than happy to do a one-on-one consultation if you'd like, if you have any specific questions. Okay, Javier, thanks for typing that in. If I'd like to convert my regular 401k to a Roth, do I have time to do that for 2019? Great question. So with regard to Roth conversions of any type of an account have to be done January 1 to December 31 of the year in order to be counted for that taxable year. So unfortunately, there's no such thing as a previous year Roth conversion. You can contribute to a Roth IRA or Roth 401k into a previous year, but you cannot convert amounts and have it counted on that previous year after January 1 of the following year. So unfortunately, no with the Roth conversions, but you can still make a Roth contribution. You just can't convert existing funds within that account into a Roth. It looks like we still got about 28 people on here, so I will certainly stick around until we have about 10 or so. If there's any other questions people want to get in, please feel free to fire them off. All right, we got one from Nathan. If I want to create a real estate IRA, can I do that with an LLC to buy real estate? And do we need a special LLC? Okay, great. Couple parts of that question. Let's unpack that. If you want to open up a self-directed IRA, absolutely, we can definitely help you out with that. That's about what 60% of our clients buy with self-direction. You can utilize an LLC to buy the real estate. The way that works in general is that you open up the account, you form a new single member LLC that your IRA is named as the sole member of, that needs to be manager managed. And then once that LLC is set up and you've completed some paperwork for Advanta and move funds over to us, we will then move the funds to that business checking account of that LLC. With regard to any type of special LLC, no, it's really just at 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 its face value is the most basic type of LLC, just a single member manager managed LLC. There's nothing exotic to it. It's a very straightforward LLC that you set up for it, and the whole process is relatively straightforward as well. All right, Javier asked, if I convert a regular 401k to Roth, do I have to pay taxes for state too? So with regard to that, it is calculated as your modified adjusted gross income. So if you are getting a 1099-R, states may look at that differently depending on if you have to pay state tax on that. At minimum, you will have to pay federal taxes on it, depending on your state and whether they consider retirement plan distributions as calculable for income on the state level. You need to check with your state on how they calculate that. I am not sure. I believe that varies quite widely on that. All right, Wayne asks, is it possible for an IRA and a 401k with different owners to create a jointly owned LLC for investment purposes? Absolutely, yeah. You can definitely create a multi-member LLC or some type of partnership between, a 401k and an IRA, between two LLCs, between anything really. You can create that for the purposes of doing investments. The only thing that I tell people to, and it doesn't necessarily matter if they're related parties, there's some additional considerations on making sure that you can't buy out or artificially inflate one person's interest, but if it's done as a straight partnership and everything like that, that's fine. Just keep in mind that if you do a multi-member LLC, you are now getting out of the realm of a single member LLC being a disregarded entity and will at minimum need to file a federal tax return for the LLC, although you probably won't have any liability. All right, Nathan asks, what if I am taking a non-recourse loan on my real estate LLC using my house as collateral? Does that require a special IRA, special LLC? So if you want to get a non-recourse loan, you cannot use a personally owned residence in order to collateralize that loan. The non-recourse loan would need to be secured by the property that you're purchasing with that LLC. While a non-recourse loan is the only type of loan an IRA can take, you cannot use a personal residence as collateral for that. There really isn't any type of special LLC. ERISA, as you've indicated in that, is simply just the legislative book, if you will, that applies specifically to 401ks. More so than IRAs. The Employee Retirement Income Securities Act of 74 really is more specific to 401ks and doesn't really give any exemptions for using personal assets as collateral, even if you were to use a solo 401k instead of an IRA. But we see clients all the time utilize non-recourse loans, and the collateral just happens to be the property that they're purchasing within the LLC or the IRA directly. Let's see. Wayne asks, can a 401k guarantee a non-recourse loan with its other assets? No. So, well, I should say not necessarily a blanket no. That's one of those kind of case-by-case things that you need to look at. If you are getting a non-recourse loan, it can be secured by an asset within the 401k. Now, you can't use that to enhance other portions of the plan, but you would need to, again, I would need a little bit more information than just I can kind of get here. If you want, feel free to just, again, pull my information off that and give me a call, Wayne. I am happy to kind of dig through that a little bit more in depth because there are potentially some circumstances where it can and can't work. All right. Let's see. Okay, so George asks, can a special needs trust / supplemental needs trust inherit a Roth IRA? Does it count as an asset for the purposes the stretch, the SSI qualified person. Um, so with regard to that, a special needs trust can be the beneficiary of an IRA, so long as that it is non-revocable upon death of the account holder. Now, with regards to a special needs trust, that's fine. With with this webinar, it actually does have some bearing. So with those types of trusts, and trusts in general are kind of looked at the same with regard to an IRA inheriting and being an inheritor of an IRA. They have to be irrevocable on death is the big thing. Is that I'm not sure how it's going to shake out with the exemption of the stretch IRA uh, rule, because the trust itself inherently is not a disabled individual. It is set up for the benefit of the disabled individual, and the ability to exempt yourself from that 10-year uh, depletion uh, depletion period, I think would hold true. But again, they weren't specific enough to really carve that out. So although I would like to say yes, it still would apply in the fact that you could not have to you can eliminate that 10-year period and just stretch it out over the individual's life expectancy. It's hard to say because they didn't specifically notate that in the legislation. But I know what you're getting at, and it's going to kind of depend because the trust itself is not the disabled individual that would be getting the exemption, although it is set up for someone in that scenario. Uh, Rain asks, if the IRA holds a mortgage on real estate, can the payments exceed the 10-year rule? It wouldn't necessarily matter. The account would have to be depleted. The mortgage wouldn't necessarily have to be sold or called. The individual that inherits the account in a non-spousal way, and I have other questions I'm going to certainly get to you, Scott and Javier. Uh, with regard to that, the beneficiary of that account or that received the account would then inherit the mortgage, and then the payments, if it's a 30-year mortgage, would then just go to the individual afterwards. Javier asked, do I have to pay Social Security and Medicare if I convert my 401k to a Roth? No, you don't. It is only federal withholding. Social Security and Medicare are not calculated into that because it's not earned income. Okay, when a Roth 401k is inherited and then moved to a traditional IRA, what kind of protections does it now have for the beneficiary? Scott, I think you might have mistyped there. You wouldn't ever move a Roth 401k to a traditional IRA. I'm just going to assume that you mean Roth 401k to a Roth 401k to a Roth IRA. So with regards to the protections that it has for the beneficiary, there really isn't any change. So let's say, for instance, my father passes away and I inherit his Roth 401k. Now I would then roll that to a Roth IRA. Now all the same typical creditor protections and everything else that's afforded to any type of Roth IRA is going to still be in place. Now, me being a non-spousal beneficiary and having reached the age of majority, I will have to fully deplete that account by 10 years following the date, my father's still alive, but by the date of his theoretical death. And we still got plenty of people on here, so I'm hanging out answering questions. Not going anywhere till typically I get about 10 people left. I've got about 26 people left on the webinar. So if you wanted to get anything answered, feel free to fire them off. I am happy to get those questions answered for you. All right, looks like pretty much everyone is dropping off. Again, thank you everyone for joining us today. This will be available for review on YouTube. If anyone that's still left has any questions that you'd like to get out, feel free to give me a call or shoot me an email. I'm always happy to schedule. Consultations are always free. So if you want to give me a shout before tax filing to see if I can help you with any questions before you call your accountant, feel free to do so. With that, everyone have a great day, and I will see you the next time we have an educational presentation. Thanks.